It's a pleasure to be here. Yes, it sounds frightening, scary, but it also is super exciting. So I'm really curious on which side you will be after our talk. Um, so we have an agenda for you. What can you expect from the talk? What have we brought for you? Um, First, we want to understand, and we make you all sure that you understand the underlying problem. What is the problem of tax compliance in collaborative software engineering like InnerSource? Then, of course, we address also the elephant in the room. Why is it a $30 billion problem? We give you some myths, actually 4 myths of tax compliance for InnerSource. What you may heard or thought about tax compliance for your InnerSource program, which might be not true. We also have a very, very short risk assessment for you, where you can identify in a very short yes or no questionnaire if your company is at high tax risk or not. And last but not least, we also would like to discuss with you how can we solve the problem in the end. Before we come to the topics, a short disclaimer. I'm a software engineering researcher. I have no legal background. Oliver is an expert on transfer pricing, but we are not lawyers. It's just to be explicit here. And again, we are talking about legal topics from a very high level. Don't take this as a legal advice. This is a very important disclaimer. But now let's get our hands dirty. What is the problem of tax compliance in software engineering, in collaborative software engineering? To understand the problem, we have brought you a very, very simple example. We simplify a lot of things, but we like to have an example company everyone knows. Let's take Microsoft as an example. And again, for simplification reasons, we assume that Microsoft has only 2 subsidiaries, one in the US, Microsoft US, and one in Ireland. And again, for simplification reasons, we assume Microsoft has only one software product in place, right? And most of it's Windows, right? So everyone should know Windows, the software product Windows. And most part of Windows is actually developed in the US, which makes sense because most of these developers are in the US. And then some parts are developed in Ireland, and a smaller percentage is then developed jointly. That's our simplified example. Microsoft Ireland now sells Windows licenses to the European market. The European customers pay for those licenses and generate revenue for Microsoft Ireland. Based on the profit, the Irish tax authorities then can tax the profits from Microsoft Ireland. Well, what's the problem? The problem is actually the US tax authorities would not see a cent if we would not consider tax compliance. Why? Because there's no revenue or profit generated in America. So there's no chance that the US tax authorities see a cent from the profits which were generated in Europe, although most parts of Windows is actually developed in the US. Yeah. To address this problem, we have a very, very simple rule. It's actually the arm's length principle. Almost all countries in the world have agreed on this very, very simple rule or principle, and it boils down to this very little sentence. Associated enterprises must operate as if not associated and regular participants in the market. That's the arm's length principle. And please keep that in mind. We'll come to that very, very often. What does that mean? Well, if you look at our very simplified example, would Microsoft US, being a regular participant in the market, give away Microsoft Windows for free to some regular participant in the market, like Microsoft Ireland? For sure not, right? So they want to get something up from that. And that's what we call a transfer price, right? So Microsoft Ireland has to pay a so-called transfer price to Microsoft US to be able to sell Windows to the European market. And that's actually generating some profits, which then can be taxed by the IRS, the US American tax authorities. Sounds good. We have kind of covered the basic problem of tax compliance. You can get your certificate after the call, download a PDF and pin it at your board. But why is it then a $30 billion problem? Why is it so tricky? Well, again, our simplified example. What if Microsoft wants to have as little taxes as possible in the US? Because maybe US has very strict tax regulations, or you have to pay more taxes in the US, and sets up a transfer price of, I don't know, 10 euros. So Microsoft Windows is worth 10 euros or 100 euros, 1,000 euros. Well, that's not okay. And according to the international tax regulation, which are defined by the OECD, tax authorities all around the world can adjust this transfer price if it's not at arm's length. Remember what would pay a regular participant in the market. And actually, this is actually exactly what happened to Microsoft. The IRS demands about $30 billion in taxes because they do not agree with Microsoft on their transfer price they set up. The case is a little bit, and with a little bit, I mean dramatically more complicated, but it boils down to this problem. If you want to know more about this specific case, also a little bit more from not from engineering perspective, but also from a legal perspective or a transfer pricing perspective, feel free to have a look in our paper where we discuss the Microsoft case in a more detail to the extent possible, and information are publicly available. But now I would like to hand over to Ollie, who's much more an expert on the transfer pricing issue, and he will try to explain 4 myths you may have for tax regulations and tax compliance for InnerSource.
Yeah, thanks, Michael. So I'll try my best to also kind of not be trapped in the complexities of the transfer pricing issues, but maybe just for starters, obviously Microsoft had a very refined transfer pricing system, but it was challenged with the consequences that Michael addressed. And why did we feel it? I mean, Microsoft obviously felt that they could defend their system, but ultimately, as we see, they came up short. So why did we feel it appropriate to address 4 myths? I remember a talk given by Milton Friedman on economics to exemplify what is the myth for us in economics or in transfer pricing. And the effect of a myth is something like he said, it's an air mattress, right? At least lets you sleep comfortable. If you have a certain set of belief that your tax system for software engineering is fine, like Microsoft had, you kind of sleep comfortable. But the purpose is to kind of look a little bit closer at this air mattress that we might be sleeping on, and to I'm not saying pull out the plug, but to kind of test whether that mattress is really a comfortable resting place, or whether it's going to end up at a very hard place like we saw in Microsoft. So I think it's very important for everyone in this having a high value added focus on software engineering to kind of double check whether or not that air mattress is really solid. So if the beliefs one has hold up to scrutiny. So let's maybe just jump into the first myth. And those are myths that we discovered quite frequently when we talked to people involved in this. And the first is that InnerSource is perceived to be like open source. And since open source is usable without a fee, it should not be taxable. So it's a very simplistic view, of course, if you think I'm just going to say to the tax authorities that, okay, my InnerSource setup is basically like an open source setup that I run within my company. despite us crossing borders and sharing information, sharing algorithms, granting access to software, we are just not going to consider any tax consequences whatsoever. This myth is wrong, because the tax authorities, and this is the tax authorities will stress this, regular market participants are excluded from participating in the InnerSource. So there's a reason why it's InnerSource and not open source. So there's a delineation implied in this entire concept. So tax authorities will really challenge this assumption quite aggressively as not being at arm's length. This is not saying that the consequence is huge payments like in Microsoft, but the consequence might be a very close look by the authorities to detect whether or not there are reasons to assess some sort of payment, right? So that's the first one. The second one is that, well, our InnerSource program is fine because we pay a transfer price that is based on a so-called cost plus method, meaning it is possible to detect some of the contributions made by various participants in the InnerSource program, and you just assign, give them back their costs, maybe plus a little margin on whatever cost they incurred to contribute programming services in quotation marks, and cost plus then is deemed to be in remuneration for those services. Well, that view is also at least shaky, is what we said here, because InnerSource usually, if you look at it, it's not like a bilateral service agreement, at least not a quite simplistic, straightforward one, and as you can often see it in other transfer pricing situations, because it's a highly integrated community most of the time, where the responsibility is the accountability, or what we call the RACI here, responsibility, accountable, who's consulted, who's informed of certain processes, is much more intertwined than in a bilateral service agreement. And because of this complexity, it's not straightforward to identify a single software engineer, let alone to group that engineer to a legal entity. And the legal entity is the important concept for transfer pricing purposes, because that's the entity being taxed. So a cost plus remuneration would usually imply that you are very able to very clearly delineate what happens in one legal entity. But if the engineers are participating in a very complex community where there are various responsibilities being assigned that are not reflecting like a straight service, but rather include a high degree of autonomy, of responsibility to double check and to make high value contributions, then that might conflict with this simplistic view that we have a cost plus system and we're fine. So that myth can also be, should also be questioned. And then I think we have actually elaborated on this aspect, on the community aspect, and what it entails also in a short working paper. It's predating the Microsoft one, but it's, I think, of pretty general applicability. So whoever's interested in seeing how cost contributions agreements might work for InnerSource structures like the one we saw, like integrated structures, is welcome to read this. I think, Michael, we have links for that prepared. Yeah. So the third myth then is that our InnerTool program is fine because we set up an IP pool for our InnerSource program, the so-called cost-sharing arrangement. Well, this is essentially the Microsoft proposition, right? So they, and just to kind of extend the example given by Michael a bit further, so they had the US, Ireland, Puerto Rico, and Singapore involved, and they essentially said, well, everybody is making a valuable contribution here, so maybe it's not equal. So actually, Microsoft Ireland and Singapore, they did like a top of up payment to be participating in this in this cost sharing arrangement. And to the cost sharing arrangement, of course, means you own everything that is produced. You can own it without paying a license, right? Microsoft did provide actually a so-called balancing payment. So Ireland did put up a fair share of money to be able to participate, which was 7 billion, I think. but the IRS just said, okay, look, since you're not even performing any substantial software development here that is on a similar level to what the US does, we are just going to disqualify you as a participant of this agreement altogether. So in substance, the agreement is void. It's not arm's length, because at arm's length, the US would not let you participate in this, irrespective of your payment, or the payment must be increased substantially. And the Microsoft case, and one thing to understand about the Microsoft case, is very qualitative. So they didn't look at what was happening on the ground, but we know from experience, and this is a dependency graph contributed by Michael here on this agreement, that you can actually see, if you really look at the data, at the quantitative data, which legal entities do contribute. So in some cases, it might be observable that distinct legal entities, in this example, US and France, are actually really integrated and making a lot of contributions, where this might be true, where you might conceivably argue, yes, we are really seeing more or less eye to eye, we are sharing in this IP, everybody makes a valuable contribution, and such a cost-sharing arrangement is really commensurate with the facts. Whereas other entities of the group might not be even close to being that much integrated or rendering that many contributions here that would qualify them as a, let's say, that valid member of that cost-sharing arrangement. In this example, for example, Germany, there's no reason, or at least at arm's length, that reason would be challenged, and one would have to have very good justification for this to let Germany participate in that cost-sharing arrangement. So again, this myth needs to be questioned. You need to be careful if you are susceptible to that myth. And then we have one more. The fourth myth is because we're saying our InnerSource program is fine because we're only sharing non-differentiating commodity code. Well, this myth is also implying a certain degree of tax risk, or is susceptible to be questioning, because first of all, you would have to clarify and document to the authorities that you are indeed only sharing commoditized software, which is not an easy thing to do. And it doesn't stop with the code, right? So where the value contribution is might also be data, might also be the operation. So that's a proposition that has multiple perspectives, where it's not just let's say, gets you over the finish line with the tax authorities to just claim, okay, this is commoditized code, therefore there's no value attached to it, and it's not important for our value chain. So if tax authorities take a more detailed look at your value chain, they will question, okay, but what happens with the data? How is this shared? So that might trigger a whole range of follow-up questions that then would need to be addressed. Well, those were 4 myths. I think pretty characteristics of what we have learned in our dealings with this. And to kind of summarize this, or to kind of consolidate a perspective on risk, we wanted to give you a very short risk assessment on how can you detect if any material risk might be valid for your case. So the first question, maybe that's like the question we all like to answer, no? Does your InnerSource program have participants from multiple countries? Well, if you can answer no, so if you're saying no, we're only doing this in one jurisdiction, well, then you're essentially off the hook, right? So you could say, okay, there's no cross-border implication. There's no profit shifting possible because it's all happening in one country. So if that's the case, then you're good to go. So that's fine, but you should really be sure that's the case. But because if you answer yes, then unfortunately you will have to address the follow-up questions as well. The second question then is software differentiating for your business model? Well, again, like we said, if you say no, then the total value at stake and the risk at stake of any potential discussion with tax authorities will be low. But again, are you really sure? Don't take the shortcut here. Be really diligent in determining what is the role in your entire business model. What are the participants doing with the software? Like, what is the value chain that software is embedded on? So that's a question then worth addressing. And then the third one is a housekeeping item, but an important one, which is, do you know which subsidiary owns which part of your software? So this is about ownership, legally and economically. So who is really entitled to utilize that software on its own, or who should, if it is utilized, and that's the last question. Do you know which subsidiary is using that part of the software? So if you're using it without owning it, well, at a third party transaction, you would be charged a fee for that usage by the owner. So the question is, do you know who owns it and who's using it to determine whether or not you can actually then well, you have to charge a transfer price. So that's a very basic risk assessment, but I think those are questions that sort of complement those myths. So if you kind of have to admit that you're sort of in the red boxes here, then it's really important also to look at what sort of myth you need to kind of look closely at. And then exactly. Then I would hand it back to Michael, I think, with the next slides, because last statement from my side on this, because now we're talking about how to solve this problem. And Michael, if you show the next slide, I think then it's obvious that what we are trying to do is bring a quantitative perspective on this. And for me, as a transfer pricing guy, that's actually the benefit working with Michael and the team to have access to this quantitative data, because in transfer pricing, a lot of the analysis and actually a lot of the tax audits that we have seen, and this for certainly includes the Microsoft one. It's kind of surprising the amount of tax at stake and the amount of discussion we're seeing is actually happening without any look at the actual software engineering, without a look at the data. So that is what is exciting for me, is that actually data exists and data can be utilized. And with this, I'm giving it over to you, Michael.
Excellent. Thank you, Oli. Yeah, actually, that's what we are actually, our vision is a data-driven tax compliance approach for any type of collaborative software engineering. So where we extract existing information from your software engineering tools like GitHub and all other software engineering tools to report the necessary data to provide a foundation for a tax audit. And actually, just to be clear on that, how difficult it sounds, so trivial. It is not, because keep in mind two things. Ask your software engineers what kind of component is in your software. It sounds so trivial, but it's not. Also, the owning question, who owns code, is also super tricky, because code ownership in software engineering is very, very sloppy defined. It's just who owns the code is the one who reviews code. This does not suffice legally, economically, definition of ownership. Again, keep in mind, data you do not collect today, you do not have in the tax audit in 2 or 3, 5, 4 years, right? So tax audits are usually a little bit lagged behind, right? So that means it's super tricky to collect data retrospectively. And also keep in mind, you also need who was assigned to which organization back in time. Do you know which legal entity you were working for this specific project for, I don't know, 2 months or so? Probably it's not possible at the scale of InnerSource, what we see at, SAP, Microsoft, Bosch, Sony, wherever InnerSource is flourishing. That's actually not possible. And it becomes even harder if you go more back in time. So although it's just me and Ollie who are presenting, actually we have a team, and the team is actually set up in a way that we work from a software engineering perspective to answer the software engineering questions and the data questions, and also the transfer pricing questions. That's how we work. We are very proud of several publications, so we openly share our findings. But please feel free to reach out with your questions regarding InnerSource, tax compliance of collaborative software engineering in general. Feel free to reach out. But of course, after our presentation, we can just jump right into the Q&A session. But for those who are just watching the recording, feel free to drop us an email. For a Kickstarter of the presentation, we have for a Kickstarter for the Q&A session, we have a very, very tiny little question for you. And it boils down to a very simple question, and we call it the $30 billion bet, right? And the question is, do you think that your company can do better in a tax audit of collaborative software engineering than Microsoft? That's actually the question. Because if not, then we might have a chat. Thank you very much. Feel free to read up the publications we have in place on our website. We also blog about the problem and the solution, of course. But now we are super happy to listen to and answer, of course, your questions to the extent possible. Thank you.